enterprise with enterprise DCF model. So to start with, what is valuation? What is business valuation? Corporate valuation is also called as business valuation. Why it is required to value a business? Yes, if a business or the shares of a business are to be transferred from one party to another party or from one entity to another entity, it is very important for both the buyer and the seller to know what is the worth of that particular asset which is being transferred. The process which is undertaken to know the worth of an asset or a firm is known as valuation. So there is a difference between price and value. That is, price means what you are paying to buy an asset or a firm. But value is what you get out of that purchase. What is the benefit that you are going to get out of that purchase is called as a value. That is, value refers to the worth of an asset, but price, it is the result of a negotiation process between a willing but not an overeager buyer or a willing but not an overeager seller. That is, I could say in simple terms, valuation is a process of determining value of a company of an asset. And it is an art and not exact science. So, depending on the kind of transaction or the structure of transaction, there may be a need to value shares of the company or a particular firm or a division of a firm or an intangible asset. Valuation is the process of determining the economic worth of an asset or company under certain assumptions and also limiting conditions, and it is subject to the data that is available on the valuation date. The valuation is subject to the data that is available on the date of valuation. Yes, as I already told, valuation is neither an easy nor you can value it exactly. There have been several methods developed to help you in this difficult task of valuation. The true value of a business cannot be established with certainty. It is really impossible to forecast accurately the future cash flows that the business would generate and to estimate precisely the discount rate that is applicable to the future cash flows. We cannot escape the element which is called as uncertainty in valuation. And also, a business is not worth the same to different parties. Different prospective buyers are likely to assign different values to the same company, which depends on how the company fits into their scheme of things. One may argue that just the way beauty lies in the eyes of the beholder, value lies in the pocket of the buyer. The primary objective of management should be to maximize the value of shareholders. Owners of corporate securities will hold management responsible if they fail to enhance the value of shareholders. Since the maximization of value of shareholders is the central theme in financial management, all managers must understand what determines value and how it has to be measured. And also, in the wake of economic liberalization, companies are relying more on private equity and capital markets, mergers, acquisitions, restructuring, and are becoming commonplace. Strategic alliances are gaining popularity, public sector undertaking disinvestment is taking place, employee stock option plans are improving more and more, and regulatory bodies are struggling with determination of tariff. In general, corporate valuation is a critical issue in such decisions. The purpose of corporate valuation is basically to estimate a fair market value of the company. So at the outset, first of all, we have to be clarified of what is fair market value is and what fair market value means for a company. The definition of fair market value, which is laid down by the Internal Revenue Service of the US, is the price at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion of buying the asset and the latter is not under any compulsion of selling it. But both the parties have a reasonable knowledge of whatever the relevant facts about a company or a firm. So this is called as fair market value. That is, when the asset that is under appraisal or a company which is under appraisal, the property the buyer and the seller are trading, it consists of the claims of all the investors of the company, which includes outstanding equity shares, preference shares, debentures, and loans. So we have to consider many factors to value a company, to value an asset, to value a division of the company. So with this note, I would also like to give an outline of when the valuation is taken up. So what are the different circumstances where there is a need for valuation? Raising capital for a nascent venture, initial public offering, acquisitions, divestitures, public sector units disinvestment, portfolio management and employee stock option plans are some of the areas, are some of the circumstances where there is a need for valuing. Raising capital for a nascent venture, it is usually nascent venture means a new venture, venture capital or private equity, it has become the important source of capital. Venture capitalists and private equity investors, they participate in the equity of investing companies that they hold for few years before liquidating the same. Since the new ventures are characterized with high risk, the venture capitalists and private equity investors, they value these businesses in such a way that their expected return is matching with the risk they are taking today. Even at the time of initial public offering, after achieving certain size and stability in the business, most of the firms will desire to access the public capital market. When they wanted to issue shares to the public, the important issue that arises is at what price should IPO be made. So for this purpose, firm has to be valued properly. And during acquisitions, so acquisitions takes many forms, takeovers, mergers, purchase of business divisions. So the value of the firm is very significant while taking over the company by another company when two companies combine together to form a new company. So these are the circumstances where the valuation is required so that both the buyer and the seller or both the acquirer and the acquiree will get equal benefits. And also for divestitures, which involves a sale of a division or a plant, it's required to value a company. It is the mirror image of a purchase of a division or plant or any unit. So such transaction depends on valuation being acceptable to both the parties, and hence valuation is very much significant here. Employee stock option plans to retain the employees in the organization and to provide the benefits to the employees as if they have to feel that they are the owners of the company. The organizations will issue employee stock options to the employees, executives who are working in the organization. So to determine the exercise price for this employee stock option, valuation of the company is required. If the company is unlisted, the valuation is required. So like this, for various reasons, valuation is a must so that both the buyer and the seller will get benefits. Both the buyer and the seller will have the satisfaction that they have paid what they are supposed to be paid. So coming to the approaches to valuation, there are so many approaches to valuation, like the different techniques that are available for valuing a firm, an asset, or a business division, or an IPO. So few of the approaches are book value approach, stock and debt approach, discounted cash flow approach, relative valuation approach, option valuation approach that we are going to discuss in first and second unit of the syllabus. What is book value approach? This is the simplest approach to valuing the company, which relies on the information found on its balance sheet. What is stock and debt approach? When the securities of a firm are publicly traded, its value can be obtained by adding the market value of all its outstanding securities. That is, if at one point of time, if the closing price of a particular company, if its outstanding shares is 1.5 billion and the market value of that particular share is 30 billion, by calculating the price per share as 20 on that particular day and the outstanding debt with the market value of 21 billion, if you simply add the market value of the equity to the market value of debt, it will give you the value of the firm under the stock and debt approach. Now, what is discounted cash flow approach? This is one of the most popular forms of approaches to valuation, and this is conceptually similar to valuing a capital project using present value method. So I will be discussing this in detail in the forthcoming classes. What is relative valuation? So it is a common sense and a logic which tells that similar assets should trade at similar prices. Based on this principle, one can value an asset by looking at the price at which a comparable asset has changed hands between a reasonably informed buyer and a reasonably informed seller. So here some of the considerations that are made is similar assets. Okay, we have to take into consideration the similar assets. We cannot take an asset which belongs to an industry which is not at all related to the industry to which the asset under valuation belongs. No, we will not get a proper valuation if we do so. We have to take similar assets or similar companies which are operating in the same business line, which are very much similar in almost all the characteristics that the other companies are in the same business line. So here we will be using enterprise multiples and equity multiples for finding out the value of the firm or an asset. And one more approach, that is option valuation approach. It is a contract. What is an option first of all? It is A derivative. It is a special contract under which the option owner enjoys the right to buy or sell something without any obligation to buy or sell. So this approach, option valuation approach, is used for valuing the stock option plans. So these are some of the approaches that we will discuss in detail in the coming classes. Then features. Coming to the features of valuation, as I already told, feature is an art and not an exact science. But the beliefs are different. One view believes that valuation is a precise science where there is no space for human interaction or human biases or errors. Others view that or argue that valuation is an art and analysts have the freedom to produce whatever the value they wanted to produce. So in this context, we have to consider few considerations which are called as features of valuation. Biases in valuation. What are these biases? What are the sources of bias? So there are several sources. The company that we choose to value, we will not choose it randomly. We will have prior information about the company. We would have read something good or bad about the company. So we have prior perception about that company that we wanted to value. So that is called as bias. The bias is involved in whatever the price that we are willing to give. Instead of a buyer valuing the company, if an analyst values a company for a buyer, he will incorporate his biases in valuation. And the current market value of the company also will influence the valuation. So these biases has to be manifested in value. How it can be done, how to mitigate the effect of bias on our valuation, that will be discussed in detail. Like there are some suggestions, like pre-commitment should be avoided. We should not link valuation from the reward or punishment, or institutional pressures have to be diminished, and self-awareness should be increased. So with this, the biases can be mitigated from the value of the firm or an asset. The next factor is uncertainty in valuation. So there are so many uncertainties like estimation uncertainty, firm specific uncertainty, economy specific uncertainty, and so there are some analysts who respond to these analysts. Okay, it is required to make a response to these analysis or to these uncertainties. So some of the sensible responses are to use better valuation models for fixing the range of values instead of fixing just one value, and providing the probabilistic statement instead of providing accurate statement are few sensible responses to these uncertainties in valuation, to reduce the uncertainties in valuation. We also will discuss about valuation complexity, that as more and more valuation models are available, the process of valuation or the task of valuation is becoming more and more. Models are becoming more complex and information is very intensive. Plenty of information is available, and there are some problems and disadvantages of this information that is available in plenty, as well as the complex models. So given the problems associated with complexity, analysts would do well to follow the principle of parsimony in valuation. So what is this principle of parsimony in valuation? We will discuss it later. We also will discuss about what are the corporate valuations that are in practice. What are the different techniques which are in practice? So like So there are three broad techniques that are in practice: relative valuation technique, transaction multiples, discounted cash flow offering. Relative valuation, it is based on multiples, that is of comparable companies, and this is the preferred approach to use in a situation where publicly traded equity and investors are valued. Transaction multiple method is used by mergers and acquisitions, and discounted cash flow method is used along with the transaction multiples. We also will discuss the importance of knowing intrinsic value for various reasons. Then we will start with the discussion of enterprise DCF model. So what is enterprise DCF model is? So as I already told, valuing a firm using DCF approach is conceptually identical as an entity that is valued, that is the capital projects that is being valued. It is same as it, but it differs in few aspects. Capital project will have finite life, but the firm is considered to be having indefinite life. And capital project, it is valued as one-off investment, but firm is viewed as a growing entity. And for valuing such kind of firms, we will take into account all the investments in fixed assets and net working capital that are expected to be made over time to sustain the growth of the firm. Under this approach, in practice, the value of the firm is separated into two time periods, that is, present value of cash flow during an explicit forecast period and present value of cash flow after the explicit forecast period. So during explicit forecast period, for valuation of the firm, this period is often taken as 5 to 15 years, and in this 5 to 15 years, it is assumed that the firm is expected to evolve rather rapidly, and hence a great deal of effort is required to forecast its cash flow on an annual basis. After this explicit period, the firm will expect it to reach a steady state, which is called as terminal value. So this discounted cash flow approach, it involves 5 steps, that is analyzing historical performance, estimating the cost of capital, forecasting performance, determining the continuing value, and calculating the firm value and interpreting the results. What is this first step? Why it is required to analyze historical performance? So to forecast the future, it is very important that you have to have the data which is historical. So understanding how a company has gone through its life in the past will provide a good foundation for forecasting its future. An analysis of historical performance is the first step in valuing the firm, and the few steps that are involved in this is you have to reorganize the financial statement so that you can better handle to the situations like economic performance instead of accounting performance, in terms of net profit less adjusted taxes, free cash flow. It has to be split up into these things. NOPLAT, which is coined by McKinsey and Company, which is net operating profit less adjusted taxes, is one of the most popularly used term for valuing a firm. That is the key driver for valuing a firm. So you also have to look at the perspectives on what are the drivers of the free cash flow. You have to measure and analyze the return on invested capital, because assets, it is ROIC, which is used to assess the ability of the company to create value. So then you have to decompose the revenue growth into various components, then assess the company's financial health and capital structure. So this will be discussed in detail step by step. We will find out operating invested capital, we will find out no flat, we will find out return on invested capital, we will find out net investment, gross investment, free cash flow. So all these, which are called as the key drivers of cash flow, will be computed, and after computation of this, we will be arriving at the value of the firm by forecasting the future cash flows. So once we do it, we will analyze and interpret the results. So while forecasting the performance, we take into consideration 3 steps: determining the length of the explicit forecast period, developing a strategic perspective on the future performance, and to develop financial forecast. So developing financial forecast involves again different steps, that is to develop the sales forecast, to develop forecast of profit and loss account, to develop the forecast of the balance sheet asset side, to develop the forecast of the balance sheet liability side, calculate ROIC and free cash flow, and check for consistency and alignment. So then the next step is we will be finding out continuing value. So continuing, to estimate the continuing value, we make use of two methods, cash flow method and non-cash flow method. Cash flow method used, the most commonly used cash flow methods are growing free cash flow, perpetuity method, and value driver method, so which we will be discussing in detail in the lecture classes. So we have to take into consideration few parameters while estimating the continuing value, like no flat, ROIC, growth rate, WACC, and what is the sensitivity that is involved of these factors while estimating the continuing value. And we also discuss about some misconceptions about the continuing value, that is the length of explicit forecast period and value, competitive advantage and value, and also some pitfalls while estimating continuing value. So there are other methods to estimate continuing value, like replacement cost method and liquidation value method. So according to replacement cost method, continuing value is equated with expected replacement cost of the fixed assets of the company, and according to the liquidation value method, the continuing value of the firm at the end of the explicit forecast period is equal to the proceeds expected from the sale of the assets of the firm. So the last step is calculating and interpreting the results. So using the growing free cash flow perpetuity method and assuming the constant growth rate, so we will estimate the continuing value and we will interpret the results. So that is, after developing the financial projections and finding out the continuing value, we will be ready to move on to the final stage of the valuation exercise. And this stage involves determining the value of operations, calculating the equity value, exploring multiple scenarios, and verifying valuation results. So determining the value of operations, that is based on the free cash flow projections. Present value of operations are calculated using discounted cash flow method, discounting the continuing value and determining the value of operations. Then we will find out the enterprise value and value of equity, where enterprise value is given by the sum of value of operations and value of non-operating assets, and equity value is the difference of enterprise value and value of non-equity assets. So, and we will be discussing what are the items that should be included in non-operating assets, so like excess cash and marketable securities, investment in associated companies, investment in subsidiary companies, non-equity clients, excess real estate and unutilized assets, unquoted investments in subsidiary companies. We will be discussing about debt, preference capital, hybrid claims, employee stock options under non-equity claims. Then we will arrive at the enterprise value and equity value. So then the next step under interpreting the result is value under multiple scenarios, that is developing the multiple scenarios and trying to arrive at the value under each of the scenarios. Then verify the valued results. After estimation of equity value, you have to perform several tests for verifying the results. That is, whatever the model that you have used is logically correct. Does the valuation results correctly reflecting the value driver economics? Are the key financial and operating ratios consistent with economic logic? Are the final results plausible? These are the questions that you are trying to answer for verifying that, or that you are trying to test for verifying the results of valuation or the valuation that you have arrived at. So this is my plan for week 1. Thank you.